Mortgage rates are still very high, and this has people wondering, will we ever see a 5% mortgage again? The short answer is probably yeah, but the follow-up question is, when will that happen? I'll show you what I mean. There are two factors that could lead to a 5% mortgage, 4% mortgage, or maybe even potentially lower, and those are more time, and number two is a recession. Let's start by talking about time. There are three ways that time could lead to lower mortgage rates, starting with inflation, because the Federal Reserve Bank has said that they want to see a 2% inflation rate. Now, the reason why I'm bringing up the Federal Reserve Bank is because they are the central bank in the United States, and they have the ability to raise and lower interest rates, and essentially, when we start to see lower inflation, they're going to feel more confident to lower interest rates, which can also bring mortgage rates lower. So you might be wondering, where is our inflation rate today? Well, inflation has fallen off of its highs, but we're still above the 2% inflation rate number. The Fed is hoping that by keeping interest rates higher for longer, inflation will fall, which will then give them the ability to lower interest rates. But the second thing you want to take a look at when it comes to time has to do with tariffs. Many people, including some in the White House, have said that tariffs could make the inflation problem worse. And this is where the Federal Reserve Bank has also said that tariffs could reignite inflation. The reason why I bring this up is because we don't know what's going to happen with tariffs. July 8th is going to be the next test when it comes to tariffs as to how aggressive tariffs are going to be, how long they're going to stay, and how high these tariffs are going to be. So we don't know. If tariffs are high and are longer than expected, then that could make the inflation problem worse, which makes it more difficult for the Federal Reserve Bank to lower interest rates. If tariffs are easier than expected, they're less aggressive than expected, then that could give the Federal Reserve Bank more ammunition to say inflation might not be a problem. Let's start cutting interest rates sooner. This is why we need time to see what the heck is going to happen with tariffs. And number three has to do specifically with the Fed chairman. President Trump has made it very clear that he wants to see lower interest rates by the Federal Reserve Bank, but the Federal Reserve Bank says that they do not want to cut interest rates right now because they are still concerned about inflation and tariffs. Well, the chairman or head of the Federal Reserve Bank is a guy by the name of Jerome Powell, and technically they're called the Federal Reserve Bank, but they're actually not federal. They're not a part of the federal government, which means President Trump cannot fire the chairman of the Federal Reserve Bank, Jerome Powell, very easily. The reason why this matters is because the White House has an opinion on what should happen with interest rates. They think interest rates should fall. The Federal Reserve Bank disagrees, but the White House cannot tell the Federal Reserve Bank what to do. However, in May 2026, Jerome Powell's term is going to end, and that's where he could potentially be replaced by somebody else. And if President Trump replaces Jerome Powell with somebody who is a little bit more favorable to cutting interest rates, that could lead to interest rates being cut, which is why, again, time is one reason why interest rates could fall, leading to mortgage rates falling as well. The second reason that could lead to mortgage rates falling is a recession. Now, yes, we've been covering a lot of this in Market Briefs. Again, Market Briefs is a free financial newsletter where every day my team is working to break down what's happening in things like the economy, housing, stocks, crypto, and the global markets into a fun, witty, and easy-to-read newsletter. We have hundreds of thousands of investors that read Market Briefs every morning. Plus, when you sign up for Market Briefs, you'll also get an investing masterclass for free as a bonus that will walk you through how you can get started as an investor and find big investment opportunities before everybody else. All of this is completely free, so if you want to join Market Briefs and get the investing masterclass, all you have to do is click the link down in the description below. When the economy is shrinking in a recession, the Federal Reserve Bank will generally cut interest rates as a way to stimulate the economy, because those lower interest rates will entice people to go out and buy more houses, buy more cars, finance on their credit cards to stimulate the economy. When the economy is booming and the Federal Reserve Bank is concerned about inflation or an overheating economy, that's when the Federal Reserve Bank will generally raise interest rates to make borrowing more expensive as a way to cool down the economy and to cool down inflation. For example, in 2001, after the dot-com bubble burst, the Federal Reserve Bank cut interest rates 11 times to stimulate the economy and to stimulate the stock market. Then fast forward to the 2008 Great Financial Crisis. The housing market collapses and the Federal Reserve Bank cut interest rates to near zero as a way to stimulate the economy, to stimulate spending, to boost our economic system. Then, fast forward to 2020, the pandemic happens. The Federal Reserve Bank again cut interest rates to zero, the lowest levels ever, to again stimulate people to buy houses, buy cars, spend money, to boost the economy, and to stimulate spending. Now, there's a couple things that I want to say about this. One of them is completely irrelevant, but I want you to hear it because the reality is it is not your duty as an American citizen to stimulate the economy. Just because they're cutting interest rates does not mean you need to go into debt to stimulate the economy. It's not your duty as an American patriot. It's better for you to be smart with your money. But let's go back to the economic side of things. When you see an economic slowdown or a recession, this can entice the Federal Reserve Bank to cut interest rates as a way to stimulate the economy. Now you might be wondering, if the Federal Reserve Bank cuts interest rates to zero, does that mean my mortgage rate is going to be zero? And the answer is no. Let me explain. Remember what I said earlier. The Federal Reserve Bank is not federal. They're not a reserve because they're not sitting on any cash reserves, and they're actually not a bank because you and I can't go there to deposit money. But they have the ability to do two things. Number one, they have the ability to set interest rates, and number two, they have the ability to create money. But let's focus on the interest rate side of things. When I say the Federal Reserve Bank has the ability to raise or cut interest rates, we know that they cut interest rates when you see an economic slowdown, and they raise interest rates when the economy is overheating. But which interest rate are they affecting? Well, they change what's called the federal funds rate. This federal funds rate is not your mortgage rate, it's not your car loan rate, it's not your credit card rate. It is the interest rate that banks charge one another when they lend money from each other. So you could think of it kind of like the wholesale interest rate that banks pay when they borrow money from one another. So banks have to pay this federal funds rate to borrow money from one another, and then they're going to charge you the retail rate, which might be the mortgage rate, it might be your credit card rate, it might be your car loan rate, it might be your business loan rate. When you go and borrow money from the bank, for my male followers, I'll draw you a nice mustache. For my female followers, I'll draw you a nice braid. By the way, in my native language, Punjabi, we call a mustache a much, we call a braid a gut. You go to the bank and you borrow money at the retail rate. So what the bank does is they get it at the wholesale rate and then they jack it up and they give it to you at the retail rate. So the reason why all of this matters is because if you see an economic slowdown, well, now the Federal Reserve Bank will likely cut interest rates. That's what we've seen happen time and time and time again in the past. Well, if they cut interest rates, what are they cutting? They're cutting this federal funds rate right here, which is the interest rate that banks charge one another. This gives banks the ability to charge you less money on the retail rate. That's less on your mortgage rate, less on your car loan rate, less on your whatever rate. And this is why a recession could also lead to lower interest rates. Now listen, I'm just a random guy on YouTube. I can't predict what's gonna happen tomorrow, but what I do know is that a recession's coming. When? Nobody knows. The reason why I know that is because if we take a look at history, we've averaged more than one recession every decade for the last century. In fact, over the last 100 years, the United States has seen 16 recessions. So we know recessions happen, we just don't know when it's going to happen. But this is where you really have to take a look at the data in the economy. For example, you might think that the job market is completely trash right now, it's hard to get a good job. But if we take a look at the data, it says that unemployment is still statistically very low. Now, are there ways to manipulate the unemployment data? Absolutely, and we know that that happens, and we know that a lot of people are working jobs that they're not happy with, that they're overqualified for, that they can't find jobs that are paying them as much as they should be worth. But if we take a look at the data that the Federal Reserve Bank is looking at, they're thinking, the job market looks pretty strong. Yes, I know that many people are drowning in debt and they can't afford to survive, but people are still able to make their payments. So as of today, based off of the data, the economy looks strong. Now that can change very quickly, and there's a lot of factors that can influence the economy. For example, tariffs, for example, inflation, for example, interest rates. But this is where you have to understand the different factors that will move the economy, because if you're focused on mortgage rates, there's a lot of factors that can change and move mortgage rates. The Federal Reserve Bank has the inclination to cut interest rates. When will they do it? We don't know, but they're paying attention to the economy. They're paying attention to tariffs. They're paying attention to inflation. They're paying attention to the job market. If the job market is very strong, well, then that doesn't give the Federal Reserve Bank much ammunition to want to cut interest rates because the job market is okay. But if the job market starts to weaken, it starts to show signs of a slowing economy, that gives the Federal Reserve Bank more ammunition to potentially cut interest rates. If tariffs are a concern, and more specifically a concern to create more inflation, that's going to give the Federal Reserve Bank less ammunition to cut interest rates because they're going to be worried about inflation. But if tariffs are no longer a problem, if tariffs come in lower than expected, if people don't believe that tariffs are going to make inflation worse, well, that gives the Federal Reserve Bank more power to say, we're not worried about inflation. We could cut interest rates to stimulate the economy even more. And this is that balancing act. I don't know what the Federal Reserve Bank is going to do, but what we can do is take a look at the data and make smarter decisions based off of that. Now, what does all this mean for you? Well, if you're buying a house, make sure you can buy a house that you can afford. Don't buy a house based off of the assumption that you're going to be able to refinance and have a much cheaper mortgage rate. That has cost people many fortunes because people think that I'll just be able to refinance into a cheaper mortgage and I'll be able to afford my house. Buy a house that you can afford. Afford the down payment, the mortgage payment, and the move-in costs. If you can do that, then treat your house like a liability, not like an asset. That way, you're actually buying something that makes sense for you so you still have money to invest, and then think like an investor. Don't get emotional. There's always headlines changing. If you can put aside the emotion, find the opportunity, you'll be the one that can build wealth instead of being the person that's panicking anytime you hear more financial news. Again, I'll be keeping you posted on this channel, and you can also join Market Briefs to stay up to date with my free financial newsletter.
I would love for you to share first, how do you think that institutions profit from our financial uneducation?
Well, I think the system, our economic system, is designed to keep the majority of people poor. After learning about how money works, you start to see why certain things work the way that they do. And I'll explain exactly what I mean.